Hello, and welcome to Virtual Investor Conferences. My name is John Viglotti, and on behalf of OTC Markets, we're very pleased you joined us for our next presentation from Lotus Resources. Before I introduce our speaker, please note to submit your questions in the question box to the left of the slides. Additionally, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome our next presenter. He's Keith Bowes, Managing Director of Lotus Resources Limited, which trades on the OTCQB venture market under the symbol LTSRF and on the ASX under the symbol LOT. Welcome, Keith.
Thanks very much, John, and it's great to be here. Very happy to be able to talk about our project. Thanks to everyone. As John has mentioned, my name's Keith Bowes and I'm the Managing Director of Lotus Resources. Lotus Resources is an ASX listed company and also on the OTCQB, as John has mentioned. We own the Kalakeera uranium mine, which is located in Malawi, which is in Middle to East Africa. I'm going to work through my slides now. So as is required in all presentations, I just need to put up this important notice with regard to any forward-looking statements that I make during the presentation. So let's talk about Kalakeera and let's talk about uranium for a little while. So Kalakeera, as I mentioned, is located in Malawi in Africa. It is a proven uranium producer. So Kalakeera itself is an operating asset. It operated between 2009 and 2014. And in that period, it produced about 11 million pounds of uranium, all of which was sent to the Western conversion facilities. So Converdyn, Orano, Cameco, those three Western facilities have all treated the Kalakeera product previously. We know when we have a look at the project, when we look at the infrastructure there, over $200 million was spent on building Kalakeera. Kalakeera is strongly supported by the Malawian government. In fact, the Malawian government owns 15% of the asset, with Lotus owning the other 85%. We announced to the market in early August of this year our definitive feasibility study, a very, very important document for us that demonstrated both to our investors, to our future investors, and also to our potential offtake partners that we're able to produce uranium at a cost of around $29 per pound. And our planning at this stage shows around 2.4 million pounds per annum for a 7-year life of mine, followed by a lower production rate for the remaining years as we start to feed in some of the lower grade stockpiles. I think what's really important to note is we are fast tracked to production. As we are an existing asset, we have all the infrastructure on site, we are fully licensed, and as I mentioned, our costs at the moment put us probably in the upper part of the second quartile cost curve as well. Now, since we acquired the asset back in March of 2020, we've spent a lot of time working on various cost reduction initiatives that we identified, things like ore sorting, alternative power supplies, acid recovery types of technologies, and all of those have been incorporated into our feasibility study, which has resulted in this low operating cost that we're reporting as part of our feasibility study results. Also, as an outcome from our feasibility study, we identified or estimated that our upfront capital to be able to recommence production at Kalakeera sits at around $88 million, which is very, very low compared to some of our competitors out there. We also determined that it's about a 15-month ramp up to first production post final investment decision. And as I mentioned, 2.4 million pound per annum production for the first 7 years at a cash cost of around $29 per pound. Now, we do have a 10-year life of mine coming out of our feasibility study, but I think it's really important to note there is significant exploration upside for their project as well, not only around the Kalakeera deposit, which we've been able to increase the resource from around 29 million pounds when we acquired it back in 2020 up to 46.3 million pounds today, but also in some of our regional targets as well. And the two most prospective ones are Livingstonia and Chilumba. Livingstonia, we've declared a resource for. So our first resource at Livingstonia is an inferred resource of just short of 5 million pounds. So I just want to quickly talk about the uranium market and why we think we're well positioned at this point in time. I'm sure everyone who's on this webcast will understand, zero carbon, the energy crisis going on and all that kind of stuff has really thrown really turned the circle in terms of the perception of uranium within the market. And if we look at the three main regions out there, so you've got Europe, really green energy focus at the moment, and that has been driven by the crisis of the Russian invasion of Ukraine. We also know there's been a lot of legislation put in place, specifically the green taxonomy, which allows uranium now to be classified as a green energy source, opening up the opportunity for lower cost financing and also for further investments in it. As I mentioned, significant shift in sentiment over the last few years towards uranium. And of course, we also note that uranium makes up about 25% of the electricity generation in Europe as well. USA, another really positive story for the uranium space as well. The US Inflation Reduction Act that came in, $400 billion investment through that. We're seeing production credits to allow the current nuclear fleet to continue operation. We're seeing further benefits or credits associated with green investments. We're seeing funding going in for things like HALEU, which is the high assay, low enriched uranium product that is required for the new SMRs, the new small modular reactors. The USA is the largest consumer of uranium, but at this point in time, there's very, very little domestic supply. There's a lot of projects looking at there as well, but obviously that's a target market for us to be able to provide our uranium into as well. And then, of course, there's China. China is such a positive story at the moment in terms of uranium. I mean, massive, massive expansion there. They're talking about building another 150 new large-scale reactors by 2035, compared to the 53 that they have operating today and the 20 or so that they have under current construction at this point in time. So again, we look globally, there's some really positive stories with regard to uranium. And I suppose the question is, well, which are the companies that are going to best benefit from that? Well, in our perception or in our opinion, it's actually the companies that have assets that are on care and maintenance. And if you look around the globe today and you look around, well, what are the companies that currently have assets on care and maintenance? Well, Cameco's got a number of them. You talk about McArthur River, you talk about Rabbit Lake, Paladin as well with their Langer Heinrich project in Namibia. You've got Energy Fuels in the USA. You've got Boss in Australia. Peninsula, another ASX listed company, but with an asset in the USA. These are all the companies out there that have mines that are currently on care and maintenance, or in some cases starting to move forward. So if we have a look at these mines out over there, a few months ago, Cameco announced the restart of McArthur River. Energy Fuels is running the Nichols Ranch asset, primarily focused on rare earths at the moment, but also producing uranium. You've seen both Paladin and you've seen Boss making FID. They're going to be coming back online again. Peninsula and ourselves very, very close to making FID. So these are the companies that are going to be at the forefront in terms of starting production. And the quotes here are around 2024, sort of, early 2024 through to late 2024 for production to come through from these mines. And what I think is really interesting, hopefully from an investor's perspective, is when you have a look at all of these companies out there, what are their market caps? I mean, Cameco, obviously a massive standout there at the moment, but Lotus Resources has got the fourth largest mine by production. So the 3 million pounds that we talk about as our production rate is the fourth largest asset on care and maintenance. And yet our market capitalization compared to our peers is still relatively low. I think we need to be getting the messaging out there, talking about, what is Lotus got? What does Kalakeera look like in the future? What are our production costs and all those types of things? And hopefully the feasibility study is fed into that. So I just want to talk a little bit about the feasibility study. As I said, a really important document for us. And what is our DFS confirmed for us? Well, it's confirmed that we're a quick restart. From making our final investment decision, it's going to take us about 15 months to get first production. Low capital cost, $88 million to restart this asset back up again. We've improved the operating cost significantly compared to when it operated previously, and we're talking just over $29 per pound to be able to produce from our asset. A robust mine life, 10 years, producing 19.3 million pounds over that period. But importantly, for the first 7 years, we're sitting around 2.4 million pounds per annum. We're fully licensed. We have our mining license. We have our environmental license. High certainty around our production levels. So 96% of the production in our feasibility study comes from an ore reserve. And we have a relatively simple operation as well. It's an open cut mine, strip ratio 1.8, followed by a crusher, milling circuit, tank leaches, resin and pulp, and then producing the final product. And I think one of the things that's also really encouraging from this as well, we spent a lot of time looking at our ESG footprint and what this can do going forward. And we're very, very proud to be able to report back that when we restart this mine back up again, we will have reduced the CO2 emissions from the operation by as much as 72% by looking at different power options as well. So a really successful feasibility study for us. Just touching a little bit more on the capital costs. So as I said, low capital, $88 million. We had previously reported in our scoping study that our capital cost was going to be $50 million. And that number is still valid for the refurbishment of the existing plant. What we're spending the additional $38 million on as part of the feasibility study is really on new infrastructure that we believe will help us drive those costs down. So we're looking at a new acid plant. We're looking at steam turbines on that acid plant to generate power. We're looking at nanofiltration upgrades to improve our acid recovery. We're looking at connecting to the national grid so we can move away from our diesel gensets and start to use the cheaper power coming off the grid. And we've also looked at upgrading the front end of the process to include ore sorting that allows us to manage our grades being fed into the plant more effectively. Also having a look at our operating costs now. So as I said, during those first 7 years when we were producing the 2.4 million pounds per annum, we're sitting around $29 per pound cash cost to be able to produce that. Over the life of mine, so over the full 10 years, including the treatment of the stockpiles, our cash costs sit at around $30 per pound, and our all-in sustaining costs over our life of mine are just short of $38 million per pound. And I think what's really important to note to the audience is we completed this feasibility study in August, and therefore all the high inflation issues that we're seeing at the moment, all the issues associated with logistics and all those types of things have all been incorporated into the feasibility study. So we have recognized the higher costs, we've recognized the longer delivery times to get our reagents to site, and all of those costs have been incorporated into those numbers that I've just quoted here as well. So I'll just talk a little bit about some of the other outputs from the feasibility study. So as I mentioned, the mining is relatively simple. It's a simple open pit mining. We understand the mineralization very, very well. It has a low strip ratio of about 1.8 to 1. We've also addressed a number of the geotech issues that the previous operation struggled with, and we've actually looked at laying back the walls on the pit to make sure that we've actually moved away from some of the issues that they had. As I have mentioned in the presentation, we have about 6 or 7 years of mining, direct feed from the pit into the plant. And for the last few years, the last 3.5 years or so of operation, we're actually treating stockpiles that have been generated and are currently on site now, or will be generated as we go through the mining activities. We're looking at contract mining as the preferred route for us to go. And as I've mentioned, within the feasibility study, 96% of the production comes from ore reserves. Talking a little bit about the processing though, so we have an original plant there that sits there and operated successfully for 5 years, producing the 11 million pounds that we spoke about. So hit all of its nameplate throughputs, recoveries, quality items and all those types of things. So we're very, very confident with the plant itself. The plant itself remains in good condition. And we've had a number of engineers visit site as part of our feasibility study. And just as a side thing, I asked them, so what happens if we were to rebuild this plant? How much would this plant cost us today? And they're telling me that if the infrastructure we have on site today would cost around $300 million to replace. So really, really good starting position for us to move forward. And of course, that's one of the reasons why we have such low capital for the restart. As I mentioned in one of the other slides as well, we have implemented a number of new innovative technologies that I think are helping us get our costs down, get our production rates up. And these aren't part of the core processes, but actually sit on the periphery of the main process. So the crushing, the milling, the leaching, the resin and pulp, the precipitation, the drying and packaging are all the core processes that originally were used on site and when Paladin was operating the asset. What we've done is tweaked around the edges. So we've improved acid recovery. We've looked at different options for providing power to the site. We've looked at improving the grade through ore sorting and those types of things. And all of those has had a really significant impact in terms of reducing our operating costs. Talk a little bit about the infrastructure as well. So obviously from the picture you can see over there, a well-constructed plant, we have our tailings dam and all those types of things already on site. But the two things that are probably most interesting for me in terms of how they've driven our costs, but also our strategy with regard to ESG, is the power, the one that I've spoken about. When the Kalakeara mine was previously operating, all of the power on site was generated by diesel gensets. Very, very expensive and obviously high carbon emitters as well. What we have done is we've had a look now at a hybrid process. So we're looking at getting power from the acid plant, so we can retrofit a steam turbine onto our acid plant and generate power from that. We're looking at getting power from the grid. We're also looking at solar and battery energy storage systems, and we'll be using a small little bit of diesel gensets either during the evenings when there's no sun shining or when we have emergency breakdowns or so. But effectively, we've been able to reduce our power costs on site from around 35 US cents per kilowatt hour from a diesel genset scenario all the way down to just a little over 10 cents. So this has had a huge impact in terms of our costs. The tailings one is also an important one to mention. So as I've said, we already have an existing tailings dam on site. We've got the engineers on site, they've done their reviews, they've done their designs. And as a first pass, they're telling us there's another 7.5 years worth of storage in those tailings dams. So we don't have to go and build any new tailings dams. And if you remember my slide from the mining, I was saying mining completes in about year 6 or so. So the current philosophy or strategy is that the material that we generate from year 7.5 onwards from the plant, we will actually then put back into the pit as a final disposal area for us. Again, reducing the footprint of the contaminated areas that we've got through the process. I also touch a little bit on exploration over here. So we have a really solid project at the moment, 10-year life of mine, producing almost 20 million pounds during that period. But there is lots and lots of upside for us from an exploration potential. So we have the Kalakeara mine itself with a large mining license associated with it. We've done some exploration around there, which we've been very, very successful with. And as I said, we've increased the resource at Kalakeara from 28 to 46 million pounds. I think there's still some more opportunities around there that we can find. But probably the area that we're most interested on at this stage is our regional targets. And there's 2 of them we've got out there at the moment, Livingstonia and Chilumba. They're about 90 kilometers to the south of the Kalakeara mine. Livingstonia, we did a drill program over there and we're able to put together a inferred resource around 320 ppm for just less than 5 million pounds. Our strategy around Livingstonia and Chilumba as well, which we've also hit some mineralization is that in the future they could become satellite operations. So they would be open cut operations with a crushing circuit. Potentially the ore sorting concept as well may also work there to be able to produce a concentrate that we can then ship across or ship up to Kalakeara for treating in the main plant. So we do think there's lots and lots of potential to grow the life of mine past the 10 years that we're reporting within the feasibility study. Just talk a little bit about the timeline moving forward. So third quarter 2022, we've completed our feasibility study. We're busy at the moment in terms of having numerous discussions with potential off-takers, both in North America, Europe, but also in Asia as well. And at the same time, we're starting to have a couple of conversations around financing as well. Anyone who's been following Lotus will know that a few weeks ago, we had a very, very successful raise. We were able to raise $25 million, which will be used for some of our pre-work, some of our early procurements and those types of things. But I think by raising that $25 million, we've demonstrated to the investors and to the market, we are capable of raising these amounts of money. And as I said, $88 million is what's required for the restart. So when you compare that to our current market cap, we're looking at a fraction of our market cap that we need to raise. Now that's if we look at it from an equity perspective. I still think there's an opportunity for us to look at some debt financing and potentially even getting some prepayments from some off-takers as well as a way to be able to generate or to be able to raise the capital for the restart. Theoretically, we could make our final investment decision by the end of this year. However, we will not make that decision until we have reached an appropriate uranium price, either signed contracts or the spot price setting a level that we feel comfortable to restart at. And then after we've made that final investment decision, as I've said, about 15 months through to for the refurbishment of the plant, installation of the new equipment, and then potentially we're producing our first product in the middle of 2024 if we make that FID at the end of the year. So just as a final slide now in terms of next steps towards production. So prior to making the final investment decision, what are the things we need to tick off? Well, we're busy at the moment talking with the Malawian government about getting a mine development agreement that will set the fiscal regime. So those are the taxes, royalties, and those types of things in which we will operate. As I mentioned, we're looking at offtake agreements with various parties, financing discussions, whether they be the equity, whether they be debt, whether they be prepayments. We still haven't decided on the optimal mix yet. We're also busy talking with Eskom, which is the Malawian electricity utility, about signing a contract, a power purchase agreement for us to get power off the grid. We're preparing an operational readiness program around recruitments, training, and those types of things. And of course, we're also starting to put together now the scope and cost for what we call the front-end engineering design, which will be done in conjunction with some early site works, we believe, once based on the money that we've got. So pretty busy at the moment in terms of ticking all those boxes. Once all of that work's been done, we'll then be looking to make this final investment decision. And maybe just a quick little comment over here as well with regard to our current financial status. We have about $28 million sitting in the bank, really backed up by that $25 million that we raised a few weeks ago. Market cap today, probably sitting just less than $200 million US at the moment. In terms of our investors, probably about 25% or so instos, a number of Australian retail investors in there. Management also has got a significant portion of the register as well. Number of ETFs have also invested in us, and we're starting to grow now our USA and our global retail base as well. So guys, that's the end of my presentation. Thanks very much for listening to me, and I'm happy to respond to any of your questions. My contact details are on this slide over here. You can contact me through our Lotus website, or alternatively at info